Joining us right now in the markets is Stephanie Ling. She is Chief Investment Strategist and Portfolio Manager at Hightower Advisors. She's also a CNBC contributor. And Steph, you were prescient. You said on Friday when you were talking to our staff that you would hold off on any of your macro thoughts because you just weren't sure what could happen on the political front this weekend. You were right. Got a lot of news yesterday. Yeah. What do you think now?
Wow, it's a crazy time. I think the market certainly could be volatile for the next couple of months for obvious reasons. But I have always said that it's the mix of Congress that is most important versus who is the president. And before the Biden news, Becky, it did look like there would be a real possibility that the Republicans would sweep both houses and as well as the presidency. So there's a lot of time ahead. We've got 4 months to go, but it does still look like whatever happens with Congress looks like Trump will likely be the president. But again, a lot of things can happen between now and then. I think you just want to take a step back. And you mentioned we have a whole bunch of earnings coming this week. We have 30% of the S&P 500 in terms of companies reporting. We're going to hear the first line of thinking from these companies. And that's the good news, right? That we're going to be able to understand the fundamentals. And that's the most important. So you can kind of, in a portfolio, you can shift towards a Trump portfolio or now a Harris or whoever it will be portfolio. I think that's kind of risky. I just want to focus on good companies that are delivering on good earnings with solid guidance ahead. And I think we're going to hear from a lot of companies. We're going to have a lot to choose from.
Why don't we talk about one of the stocks that you had owned ahead of time last week, DHI, D.R. Horton, came in with numbers that were better than expected. You had owned this before. What does this tell us about the housing sector writ large?
Well, I do think that the housing theme is like a decade-long theme. And I have been saying this for quite some time. And a lot of that is because we have a shortage of housing and houses, if you will, right? We're 5 million homes short in this country. We have 5 million millennials that are first-time buyers. And if you talk to any of these companies, and I do talk to D.R. Horton quite a bit, they'll tell you that they have been underproducing for the last 14 years. And they would rather buy back their stock than actually buy land. But the good news is that inflation and land costs are coming down. And so that was a big theme for them, as well as solid demand. And I like D.R. Horton because they're in the Southeast and also because they have about 57% of their order book is first-time buyers. So that's one that I like. And by the way, it's trading at 11 times forward estimates. So it's had a nice run. It's had a nice recovery, but I still think you can buy it here.
But you also like Home Depot in this space, too, just broadly speaking, for this thing that you think is a decade long.
I do. I like it. It has done really nothing in the last year and a half. They were a beneficiary of COVID when everyone was buying stuff for their homes. And then they actually had that hangover. Over the last 5 quarters, they've missed same-store sales, which have been disappointing, which is why the stock hasn't done well. But I do think that you have very easy comparisons. And exactly to your point, like if you believe in the housing theme, then you have to like something like Home Depot. And it is trading, it's not cheap at 21 times, but it's trading below its historical average of about 25 or 26 times. So I like the risk reward and the very low expectations.
Steph, let's talk about another theme. You said at the top you're assuming that former President Trump is going to be elected again this time around. We had a lot of strategists last week who were saying there were many sectors that would probably do well under a President Trump administration, but oil was not one of them. They figure this whole idea of drill, baby, drill means more supply, and that means oil prices come down. But you like Schlumberger, an oil services company. You want to explain why?
Yeah, I do. And I agree. I mean, I kind of go back and forth with oil under a Trump presidency because it's drill, baby, drill, but it's also probably more growth in the economy overall. The sector is like kind of been left for dead. The Schlumberger, or SLB, it is trading at 13 times. It's the #1 player in oil field services, and they just reported earnings on Friday, and it was very good. In fact, they have beaten expectations for the last 4 consecutive years. and yet the stock really hasn't done that much as well. And so I think there's real value here. On Friday last week, when they reported, they beat at 3 out of the 4 divisions, and margins expanded 162 basis points year over year. You own SLB for their international exposure at 79% of EBITDA, and that part of their business actually grew quite nicely. And their digital franchise, all about technology, right, and all about AI. Their digital technology did very well, and their margins expanded 200 basis points in the digital segment. And why it's important is digital is going to be about a $3 to $4 billion business for this company over the next several years, and that carries higher margins. So I think that bodes well for the operating leverage potential. So again, 13 times for the number 1 player, I think it's pretty interesting.
So SLB was Schlumberger's stock symbol for forever. They changed their name to SLB. They just get tired of people calling them Schlumberger.
I think so. I think so.
Probably.
Certainly.